Okay, it's 12:01, so we are going to start this meeting. Welcome everyone for joining us. I'm Ludivine Wurzik, the Executive Director of the French American Chamber of Commerce of New England, FACCNE. We are a nonprofit organization based in Boston, and our mission is to assist French and American companies in their business relationship. I'm very happy to say that at this time we have 400 members locally and 6,000 members in our national network. Here in Boston, our companies, member companies are mostly in innovation and services. And we currently have 4 groups of experts already assisting our member. These are in healthcare, software and technology, HR, and we also have a Women in Business group. And I'm very happy today that we are launching the activities of our newly launched Finance Forum under the leadership of Louise Roussel. And Louise, the floor is yours.
Thank you, Ludivine. Good afternoon, everyone, Eastern Time. I'm very excited to launch today the first event of FACC'Fin. We're going to discuss various topics around funding growth and valuation, and understand some investors' perspectives. We have senior executives from private equity firms and investment banks, and we are going to divide our discussions in 2 panel sessions, interrupted by a networking break. I will be moderating the first session with Patrick Gengoux, principal at Seacoast Capital, and Helenn Lemaistre, investment director at Credit Mutuel Equity. The first session is going to be focused on sources of capital. And then we will have Jean-Noel Pellegrin, Senior Director of Valuation and Finance Support and M&A at Sanofi, and member also of the FACC'Fin Forum. He will direct the second panel with Alan Fullerton, partner at Mirus Capital Advisors, and Isabelle Ossour, Managing Director within HSBC's Industrials Investment Banking Division. A few words about FACC'Fin. So this is a newly created forum within FACCNE. The purpose is really to connect individuals in finance, members of private equity firms, investment banks, advisors, bankers, corporate finance executives, business owners, and leaders through a variety of events, and to develop relationships and broaden our network within the New England community, and I would say with a French twist. So I hope you enjoyed this session today. And with that, I will invite participants throughout the panels to ask questions on the chat function of the Zoom. And otherwise, we will have the networking session to be able to discuss with the panelists and the members of FACC'Fin. With that, we will start our first panel session with Patrick and Helenn. Patrick and Helenn, I would like to invite you to provide a little brief introduction about yourself so we can kick it off. So Helenn, could you tell us a little bit about you and your firm in a couple of sentences?
Yeah, thank you for having me. Helenn, I've been in Boston for about 5 years, representing Credit Mutuel Equity. It's the private equity arm from the French banking group Credit Mutuel Alliance Fédérale. Our private equity practice is more than 40 years old. We invest into lower mid-market companies and support them in their growth in Europe and now in the US.
Great. And Patrick?
I work with Seacoast Capital, and we're a non-controlled junior capital investment fund. We invest subordinated debt, preferred equity primarily in companies that do 10 to 200 million in revenue and call it 2 to 15, 2 to 12 million EBITDA. And we're primarily called in to provide growth capital. So if you're looking to make an acquisition or build a new plant, that sort of thing, we can come in and provide that financing. And we've been around for about 20 years, and we're pretty industry agnostic when it comes to the companies we look at. But that's our approach.
Fantastic, thank you. So as for me, I will say I'm a senior banker at KeyBank, based in Boston. through my career, I've interacted with Helenn and Patrick a number of times. I've worked very closely with Seacoast Capital over the past few years when I was at a firm called G2 Capital Advisors, an investment bank based in Boston as well. I've approached investments in many different ways. But one of the things that I think is important to discuss today with having your two opinions, raising capital and selling ownership for an entrepreneur or business owner or founder is probably one of the most challenging decisions. And it consists in giving up, to some extent, equity, ownership, and giving a part of themselves. And while it's commendable to get by without outside capital, it may not be the right strategy, and there's always a point in time when you have to get to, all right, what capital do I raise, and what is the right timing? Could you, Patrick, give some thoughts on that and examples on what do you think is the best timing and the best reason for raising capital from your point of view?
Yeah, absolutely. I mean, the basics is that you have a project before you which will result in a certain return on investment. To the extent that that return on investment is higher than your cost of capital, you are going to be better off to bring in outside capital to do that project. And so we're typically brought into companies that have reached a certain plateau, shall we say, and they have before them a number of growth opportunities, but they either don't have the capacity to borrow from their senior lender enough money to access those opportunities, or they can't generate enough cash flow internally to finance those opportunities. And so they'll come to us, and typically the senior lender will be asked to provide the capital first, and the senior lender will say, well, we can provide 70% of your need, and then we'll come in and provide the incremental amount. I think it works particularly well when there is, at least for us, when there is a business that has a strong cash flow foundation that we can build on. And essentially what our capital does is it comes in and layers on top of that and allows the company to then expand and grow and undertake these projects, such that you then go from this starting point to a new plateau, and through that the value of the enterprise goes up. And even though there may be dilution to the entrepreneurs and the owners, their smaller ownership percentage is now worth more than it was before they undertook the project. And that's basically how it works, and when it works really well.
Helenn, is that how do you think about the best timing and to seek new capital? How do you evaluate your investments, in that, with that in mind?
Yes, it's a great question. I wouldn't say there is a good or appropriate timing, because I think that there are investors that invest in different stages of companies. So there are investors who are very interested in early stage companies, for example, and other in more mature companies, as we are, for example. So I would say there is almost an investor for any needs that you would have. So it is very important to be to know your strategy, of course, and to know what you need and what you don't have. An investor is really helping you to accelerate your growth, and will help in any weakness that you can identify. Is it your team? Is it your lack of access to certain customers? Is it your size in a particular market? So the more you have done your homework over your own company, the better you're prepared to address to the right investor.
So I think, the time is always the essence of a decision for all constituents, for a founder or for a business owner, for a company. It's only, at what time of your growth trajectory, at what time within the year, within the markets. But there's also different considerations, like the cash flow impact of raising capital, how is that going to impact your ability to pay interest, amortization, make dividends, and also what's the impact on equity dilution, right? Whether it's 12 months from now or 6 years from now, that's what you usually calculate. But so for you, Patrick and Ellen, as investors, when you think about yield, how do you think about yield? How do you think about that timeline, that cash flow impact? What do you look for specifically?
And then I'll let you go first.
Mm-hmm. Yes, so investors are looking for a higher return than debt providers. In mature companies, investors are aiming at 15 to 30% of return. So that's very high compared to debt. For that reason, they're ready to take more risks and maybe go through harder times on a short term to get their returns over time. So again, it's very important to figure out, the length of your project, how it's gonna ramp up, and how long you need this additional capital. You have investors who are looking for returns on a rather short-term basis, 2 to 3 years, and others like us who are, because we invest our own funds, who can get their returns on the longer term, 7 to 10 years. So maybe if you're going to have a growth trajectory with some family transitions or some, different projects to finance at the same time, maybe it's a safer strategy. On the contrary, if you're on a very technology business and you really need a very fast acceleration, you will look for an investor who can put more cash, maybe take the control of the company, but really accelerate your growth and beat the competition faster, maybe.
Patrick, I think if I'm correct, you have a kind of a similar timeline, but you also have the flexibility to invest in different types of instruments, right? So how does that
Correct.
affect your decision?
Yeah, correct. I mean, I think kind of building on what Helenn said earlier, you do want to match your capital structure to your strategy and make sure that you have kind of the appropriate mix of securities financing your company to kind of match, because there's kind of three, I think of it as three key variables to these things. It's fundamentally the future cash flow, right? And one is the timing. So when will you start realizing that return on that investment? 2 is the magnitude of those cash flows. How much will you realize? And 3 is the certainty of those cash flows, meaning like what's the actual probability that you will realize what you think you're going to realize, right? And so to the extent that you have very well defined, highly probable cash flows that are going to come, sooner rather than later, debt becomes a very nice match for those kinds of investments, right? To the extent that you have highly improbable but potentially very large cash flows, you're looking at more of an equity security, and which is going to be more dilutive, but also isn't going to have things like debt service attached to it. And so that's a better match. And then of course, most companies fall kind of somewhere in between those two, right? And so then you're looking at the art of it. And I think that really does come, that's where the art of what Helenn and I do in sort of helping these companies is figuring out, okay, you have a plan, you think you're going to do this, well, based on everything that you know, and based on everything that we know, we think that the mix of capital ought to be this. And on our side, we are flexible. And so we will put, a combination of subordinated debt, which will have current cash coupon, which will, is better suited to kind of steady cash flow structures. And then we'll put in, preferred equity, which is going to be more sort of fit to, shall we say, a little higher uncertainty, but maybe a little higher payoff, right? And so that is kind of where we start to really work with the company to kind of try to dial that in and optimize that aspect of it. And it's really, it's more of an art than a science at that point.
It looks like there's a lot of flexibility in how you work with clients too, right? So you look at a situation and then you adapt your product in a way to their profile.
I think that's right. I mean, I think, you know, each company is a unique entity, and it has its own idiosyncrasies, et cetera. And we spend a lot of time on the front end, and that's, you know, that's kind of the where we probably add the most value, is in helping craft that capital structure. And we take a very collaborative approach with the management team to make sure that we all agree that, okay, this is strategy. And based on this, we all agree that this is what the capital structure ought to look like. Because the worst thing that can happen is that you mismatch your securities, and then all of a sudden your capital providers are the ones that are dictating what your strategy ought to be. And at that point, you know, nobody's won. Everybody's losing. So we want the management team to be able to do what they want to do, and we want to have kind of the effect of that and the benefit of that to come back to capital structure appropriately. So it's a very important thing and a very subtle thing that we sort of work all together on upfront.
Mm-hmm.
And if I may add that, flexibility is important along the road as well, because we all spend time on you know, forecasts and everything, but things never happen as planned. In a good way, fortunately, most of the time, but in bad as well. And we have to, you know, the investor has to be ready as well to help in harder time. And it's important for the company to stay open, that, you know, at some point it might need some additional capital, or some mezzanine debt, or the structure of the beginning can be very different down the road. And again, it's very important that all the stakeholders can be aligned on a good understanding of the project and how it may turn out.
Yeah, that's a good segue to kind of the last theme I want to cover here. How are you involved after you make your initial investment? You know, we always see like the process of capital raise. It's such a long and tenuous process in a way. You know, what happens after? How do you interact with the company? How do you stay on top of, you know, as you said, like the numbers changed, some things don't go according to the projections. So what happens after?
I can start. It really depends on the company and what its need is. We are a minority investor, so we're not hands-on. We are board members most of the time. We can be observer. We don't have to, you know, we're not looking for the control of the company. It's very important, and we'd like the management to have it. But we are in a very transparent relationship. We like to be aware of what's happening, and we want to participate in this discussions around the strategy, because that's how we can bring the more value. Again, the more the management team is ready to share and be open, the more they can take value out of this partnership. So it's very important for us to get the information without, you know, loading the management team with new reporting or everything. It's really for us to have material data to have constructive discussions.
Mm-hmm.
Yeah, I couldn't agree with Helenn more. Our approach is very similar. I think we feel as though we're doing our job and we're successful when the management team starts to call us on a weekend because they have, you know, they had a brainstorm, they had an idea, they have a problem, and they don't quite know how to solve it, and they want to just bounce the ideas off somebody, right? And if we can have that relationship where, you know, there's that trust, there's that collaborative kind of approach on both sides, then I think the outcomes is usually a lot better because we're all working as a team towards a common goal. We are by no means expert in any particular business. The management team has sort of by definition always more information, more insight, better knowledge of what's happening than we ever will. But we have seen a lot of companies, and we've seen a lot of situations that maybe the management team hasn't. We've sold more companies than they have. We've raised more capital than they have. Things like that. So there are areas where they're going to know more, and there are areas where we're going to know more. And when we can share all that and work together is where we think we win. And for the most part, we do. And one of the things we're very proud of at Seacoast is that we have a number of former portfolio company CEOs as investors in our fund. And that is something we try to nurture and build because we find that there's tremendous value. The CEO position in a company is often a very lonely one. And there's not many people that they can sort of call when they're not quite sure what to do, right? And so we try to be a resource to them in that way.
The weekend calls are the best. Well, thank you, Patrick. Thank you, Helenn, for this first discussion. With that, we'll invite everyone to join the networking break. All right, I think everybody should have clicked the submit button by now. So with that, Jean-Noel, I'm going to kick it off to you.
Yes, thank you. Do you hear me well?
Mm-hmm. Yes.
Okay. Okay, thank you very much. It's a great opportunity today because it's our, as you said, Ludivine, it's our first forum, and I'm sure there will be others, plenty of others. We will have many opportunities to share about finance topics. And our first session was more about raising capital and the investor view. And in fact, here we wanted also to have in fact, to take some time and to open a little bit the file of the company, searching for financing or for investors, and have a look at what is inside the file. We have a business case, we have valuation, cash projections, and we wanted to see together, and with our two great panelists today, what would be the investor view from your view, from an investment banking view, and what would be the good practice or good advice you would give to the entrepreneur preparing his presentation of his company, his or her company. And I think it would benefit our audience today to have to be in the investor's shoes, but also in the entrepreneur's shoes. In fact, we are lucky to have great panelists today. We have Isabelle Ossour, Managing Director at HSBC, sorry for that, and Alan Fullerton, also a partner at Mirus Capital, and both have deep expertise in investment banking. Personally, I have a complementary background because I am more in the corporate finance world, working at Sanofi for business development and M&A transactions. So our first, so maybe Alan and Isabelle, you can introduce yourself a little bit more.
Sure,
Isabelle, do you want to go?
Sure. Hi, I'm Isabelle Sword. I'm based in New York. I've been graciously invited to your forum. I've been an investment banker for almost 2 decades now, and spent 15 years of my life in the US, 5 in France, professional life, because I'm not 20. But most of my time in M&A and otherwise covering industrials companies.
And I'm Alan Fullerton, partner with Mirus Capital Advisors in Boston. I'd like to thank Louise for inviting me to participate here. And I see a lot of familiar faces and names, so it's good to see everybody. We're very focused on working with founder and family-owned businesses, typically in what we call the lower middle market. So companies from $10 million to $200 million of revenue or valuation range. We work in a variety of situations, from M&A to growth capital. The last 3 transactions we've done in the last month have been a strategic sale, private equity platform, and an add-on for a private equity firm, just to give you a sense of types of work that Mirus does.
Okay, so thank you very much. So in fact, what would be interesting as a start is to go back a little bit to the essential around the valuation of the company, and what would be your main area of focus, your point of attention from your own perspective. I know that you, Alan, and Isabel, you have seen hundreds of cases and good and bad practices, and you have your own point of attention. So maybe Isabel, you want to start?
Yeah. Maybe one thing in particular, in my life, my career, I've covered privately owned company, founder owned, but also publicly listed company, and sometimes one becomes the other and vice versa. At all time, even for managers in corporate finance, you want to have a view on your own value of a company. And in the big picture, it's also what do you do with your cash when you generate cash and you're not a bank? First, you spend it organically on R&D and CapEx. If you still have more to spend, you can look externally, like in M&A, to grow inorganically. And then the third would be if you've done all of that, it's just and you still have too much cash, is returning cash to shareholders and when you're a listed company. And for this, you also need to have a view at all time about the intrinsic value of your company. If we go with the large companies, you're going to see sometimes some of the part analysis, and is there more value if you break up the company? So maybe this is more for the larger company, but sometimes activists, if you've heard of them, like come and knock at the door, rattle the cage and force you to review that all the time. So board members, management, always have that front and center. But then, and I'll turn it on to Alan, in terms of thinking about valuation, it depends on almost three things. One is, it's going to be the context. You're valuing a company intrinsically, but not in a vacuum. So, what is the context? And we can later on say a word or two about the fact that we're in this post-pandemic world, and what do we see from an M&A perspective. Alan was just saying he just closed 3 transactions in the last month, so we're seeing quite a bit of activity. And then when you have a transaction, you have a buyer and a seller, and how do you make those expectation meets? Because the seller is going to want a very high valuation, and the buyer is going to want the right price. And how do we get to that? But before maybe I'll go back to the context, I'll turn it to Alan if you want to add something.
Sure. I think Isabel and I have talked. I think in terms of the current markets, remarkably high valuations for companies. So I think that's sort of a common understanding. I think for us, we're often, you talk about metrics and things, we're often outside of technology, very focused on EBITDA, earnings before interest, taxes, depreciation, amortization, as a kind of proxy for cash flow. But I think most of the folks here will understand that you really do have to dig quite a bit deeper to understand sort of the quality of cash flow, and then what's the appropriate multiple, and that's really market driven. And so you may have an industry that's very capital intensive, which doesn't generate as much free cash flow per dollar of EBITDA. You may have other segments where you've got a really high recurring revenue model, very sticky client base, and you get very high multiples of cash flow for those businesses. And then I joke with the tech folks here also that they don't read the P&L below the first line, so it's really just revenue. They don't care about the rest of the P&L. And particularly for SaaS software companies, that's almost true. So looking at revenue metrics, growth metrics, retention and churn metrics is most of the valuation exercise that we go through.
And maybe hearing from you both, in fact, we could imagine that you would have some challenge when you deal with early stage companies, when you don't have a lot of let's say, hard data or easy comparables. And so can you share some experience with us in this type of context?
Maybe one thing is, like, no matter what, no matter how advanced or not advanced or unique or early stage you are, you're going to need to have a view on your budget and feel confident about it, but also have a view on a business plan. and as strong of a business plan or as strong of a case that you believe in, and you can back out by trends, by what are the drivers. Because no matter if you're a buyer or a seller, the buyer will look into that and will have his or her own view and will layer in some synergy on top of that. But as a seller, you need to have a strong case that you can defend, because prospective buyer will ask you questions and will poke at it. And any investors, really, actually, even debt investors, will want to have a view on your cash flow. So developing a set of projection that you believe in and can back and justify is, I think, is the prerequisite of any process.
I agree. I think it's also very domain specific. So the early stage biotech company is very different from the early stage software company, and fundamental things like IP, but also just capital intensity is something that you should look at. I think that from our point of view, what we don't do much with very early stage companies outside of some med tech. But the one thing I would think about is just the timing to get something done. It takes longer to convince somebody who's going to invest millions or tens of millions of dollars that an earlier stage project or business is the right one to take a bet on. From an M&A point of view, when we're working with companies that are generating, a few million of free cash flow, it's a process of a few months to generate interest and work towards getting a deal done. Whereas earlier stage companies, it can take a year or two for people to really understand and get to know the people and get comfortable with the opportunity.
Yeah, and in Sanofi too, in fact, there is a tendency in our projects now to present. Also, what the one slide is what we have to believe, and you find a lot of bullet point, and you say, wow, we have to believe a lot of things when you have a lot of uncertainties. And in this context, in this situation, do you pay attention to the, for example, to the management, the story of the management, their execution capabilities or demonstration of it?
I would say yes. I am involved with angel investing, and I think you look at what's the opportunity that people are chasing, but if you don't have a great management team, anybody can have an idea, right? So you need people who can execute. So I think it starts with the management team.
Yeah,
I would echo that.
Okay. And so I'm looking also at the clock. So it's a good transition, I think, to the second aspect of our discussion regarding the management. So the management will be, of course, would have a strong collaborative work to do with them in order to build a common view, I guess, on the company's perspective and value. And so what would be the good practice you would like to see in the management approach, working with you or building a business case? The good practice and the good advice, of course.
Are we talking in the context, because also as advisors, Alan and I, we can be on the buy side, as we call it. We can help you buy something, review it, and conduct diligence and coordinate all of that, but also the sell side. If we're on the sell side, a company or an entrepreneur or founder or a company want to sell a division, we will help you prep the case. And then when we prep the case, maybe more on the sell side, if this is maybe where people would be more interested in, we're going to come in and live and breathe with you for a few months. As Alan was saying, it takes some time to prep everything. I did mention the set of projection is like almost the basics of everything, and the backup and the market and maybe market analysis. And then when it will come an interaction with potential prospective buyers, we will do this analysis of who your company should be potentially shown to. And there's question if you want to run a large process or you'd rather keep it relatively confidential if there's obvious buyers. And even if you had one person reach out and you felt, oh yeah, I'm going to sell it tomorrow, what we can bring is some competitive tension. You want to keep everybody honest. You want to keep the buyers honest. And even if someone may have already a foot in the door, if they feel some competitive tension, they'll it will make sure that they're trying not to get you too much on the cheap, I want to say. And then in terms of for management, we would be there and we would help you prep. We would help you describe the company. For you, it seems obvious, you live and breathe it 24/7, much more than we do, but we'll try to help you put some crisp message around it and making sure you're addressing all the most important points for investors. We'll do dry run and help you present the company the right way. That's what we do along the way. I'll pause here maybe for Alan to add a little bit to that.
I agree. I mean, I think that's a lot of the value that an investment banking advisor brings. And I think, from a valuation point of view, we really think valuation is market driven. And what I really mean by that is, we may get a dozen offers for a client or several dozen offers for a client. And there'll be a few acquirers or investors for whom it's really a great fit. There's many private equity firms as there are out there. They're not all the same. I liked Helen's comment, about there's, capital for any project. But so part of it is that matchmaking. The reality is finding the few potential acquirers and investors for whom this is really interesting. And usually they've done homework in your market. They may have looked at other companies in your industry. They're really looking for the right company to acquire or invest in. Those are the folks who will pay the most. And so valuation is not a hypothetical exercise at that point. It's very much a market-driven exercise in running a process, keeping everybody honest. It can be worth a lot in terms of valuation.
Maybe the one more point I would make about valuation, if we think about it, we talked about projection and the intrinsic value of a business, a division, a company, and anyone almost could run a discounted cash flow analysis to get a sense of it. But then a process, when it happens, doesn't happen in a vacuum. So if we were to take a year ago, I remember I was asking for bids on an asset on March 23rd. I had timed the trough of the market. There was no financing available. I can tell you it didn't go that well and everything was put on hold. Today would be the opposite. You're seeing left and right processes and assets coming to the market because the valuation of companies that are listed are at all-time high. The stock price in most spaces, maybe commercial aerospace exposure is not yet at all-time high, but a lot are at all-time high. So when you're a seller, you're thinking, hey, I want to take advantage of that. Doesn't mean that where you see the listed market trading, this is where you're going to sell. It may take time for your expectation to come back and down a little, but also for the buyers to compete and really want to be there. And the third thing, if the company is large enough and you have private equity looking into your asset, and that comes back to the first panel, private equity ability to pay will also be a matter of the leverage market, how much they can lever the business. It will be a matter of like how much your business cash flow generates cash flow, but also is the debt market crazy high and everybody's leveraging pretty high at low rates, and that because private equity focus on returns. So all of that comes in together and helping you navigate that is what Alan and I would be doing.
And do you think a dossier is more convincing, or an entrepreneur is more convincing when he talks openly about the vulnerabilities of his business?
I would say part of the preparation is identifying what we call the risks and also prepping the mitigants, meaning being aware. You don't want to put anything under the carpet. It doesn't go that well, because in diligence, people will try to find the issues. So if there's any risks, be aware of them, work on identifying them, but work also on identifying the mitigants. And there's also the what if once you're part of something bigger, this is how you will solve that issue, and this is why it makes sense. So you want to be prepped at all time and prepped ahead versus getting the question from an investors and you haven't thought about the answer.
Okay.
I think that's one where preparation really pays off, just being ready to address those issues. And then, as Isabelle said, you really don't want to hide things. You really need to be upfront with folks, and it hurts a lot if things come up late in diligence. It's much easier to deal with things early on in the process.
Yes, and I think also that it's great that then you can feel that the business case has been prepared with a good level of transparency about risk and mitigation. And I think, don't you think also that it's also very convincing when all the upsides have not been taken? It's even more convincing, no?
Maybe like I would give you an example for sometimes what we see if we deal with private equity buy companies believe they have a unique angle and to bring them to the next level. But when an asset has traded already from one private equity to the other, from a second one to maybe a third one, honestly, like there's not many other private equity who want to look at it because there's like, what else is there left to do? Everybody wants to have a unique angle. So then maybe that's the time you're ready to just be on your own and tap the equity markets. But yes, people are looking for angles.
Yeah, absolutely. Thank you. So, in fact, maybe we can open the discussion also to with other panelists to a Q&A. In fact, in conclusion, if I may, I would say that my conclusion is that the valuation, and all the work what is behind is in fact serving a purpose which is also a communication purpose, and the beauty of it is when all parties can find a common ground about the perspective of the company and of course the value. So,
Jean-Noel, maybe I will ask a bridge question to Patrick and I'm sorry, and Helenn, because I think, you know, on the topic of valuation, there's always a different perspective when you're in the sell side or even the buy side, and when you're trying to bring in minority investors or debt lenders, even, you know, if it's a recap, for example, and sometimes they have a different point of view on valuation. Patrick and Helenn, do you have anything to say about that, like in experience with, you know, situations where there was a discrepancy in valuation or a disagreement even?
Yes, it's often a very sensitive issues. We often think that if there is more than 10 to 15% of difference in valuation between the seller and the buyer, it's going to be hard to come to a common ground. So we can pass because valuation, as you've heard, is very subjective still. But however, when it's a question of minority investor, I think it is less sensitive because the dilution will be smaller anyway, with a smaller piece of equity, and more so with debt or with mezzanine. Maybe Patrick, you have more experience on those less dilutive products.
Yeah, I mean, I think that when we run into this situation in sort of an interesting way, which is an entrepreneur will have hired an investment bank to market the business, and they're not getting their number. I think every entrepreneur kind of has a reserve number in the back of their minds as to what they think their business is worth, and they're not going to take a penny less, right? And so we've actually been called upon to provide sort of a growth financing in those situations where the market was just telling them, no, your business is just not worth what you think it is. And so the bankers will ask us to come in and provide growth capital so that the entrepreneur can go and continue to build the business for the next few years, with the idea that at that point the value will have increased sufficiently so that they can get their number and get the deal done. And so we've often sort of helped bridge that very issue in a very different way, essentially just looking to help the entrepreneur get to where he wants to go once the market has sort of spoken and clearly, resoundingly said, you're not worth what, or your business is not worth what you think it is. So that I think that does come up fairly often.
Thank you, Patrick. Well, thank you, everyone, for joining this panel. Thank you, Patrick, Helenn, Alan, and Isabelle for participating as panelists, and Jean-Noel for moderating as well. And if anyone has any follow-up questions, feel free to reach out to the FACC'Fin members as well. With that, we have a final survey if you have a few spare seconds. Thanks again, everyone.